mistake, the MFI is considered unconventional. Why? Because it incorporates volume and price into its analytical base. By doing so, the MFI can measure the amount of capital moving in and out of a market, hence the name money flow index. Like other oscillators, the MFI is too complicated to derive by hand while you're trading live. If you're not a mathematician, don't worry. You don't have any heavy math to do to use the money flow index. The MFI's functionality is fully automated. Best of all, it's a public domain indicator, so it is included free of charge on many trading platforms. Now, the money flow index is represented on a scale of 0 to 100. It is designed to indicate when a market is overbought or oversold. Here's the key thing to remember. When the MFI is above 80, the market is overbought. When it's below 20, the market is oversold. All right, let's get you set up with the MFI on your TradingView and MetaTrader 4 platform. So you can see right here, we have our triple screen trader. Let's go ahead and add the money flow index very quickly to our pricing chart here in MT4. You go right up here to insert, you're gonna go to indicators, and you're gonna go to volume. Now it's important, even though it's an oscillator, you're gonna find the MFI under volume. You click on money flow index. We're already set up with our 14 period default setting, and you can see right down there's your MFI below price action, its own separate window. TradingView, simple as well. You can see right here, we have a 4-hour Great Britain pound USD chart. We're going to go right up to indicators. We're going to hit indicators, and then we're going to cursor right down to our MFI, or our money flow index, and it's right there, money flow index. We're going to click on it. Once again, we're going to leave our default settings right there. You can see it comes up in its own separate window. There's our bands between 80 and 20, and you'll notice right there 14 period default. So there it is, very simple to add to MT4 or TradingView, and that's the money flow index. Okay, there's several ways to trade the MFI. We're going to start with the most basic, and that's to buy an oversold market and to sell an overbought market. Let's show you how to do that right here. You can see on our 4-hour Euro USD chart, we are in oversold territory when the MFI drops beneath 20. So we drop beneath 20, we're looking to buy the market. It's as simple as that. We get a value of an MFI beneath our 20 threshold. The market is oversold and it's time to buy. Right there would be a buy, and right here would be a buy as well. Now, the other way is that when we're in overbought territory, it's time to sell the market. So when our MFI rises above our threshold of 80, we are technically in overbought territory. It's time to sell the market. As you can see right here on this peak, we would be looking to sell the market right there. Why? Because we have a reading upwards of 83, 84, and then you'll see on this peak as well, we've got a reading somewhere up around the 82, 85 area, and that would also be a signal for us to sell the market. So remember, easiest way to trade this, oversold, we're looking to buy the market, and when we get into overbought territory, we're looking to sell the market. Now let's go into a more complex way of trading the MFI, and that has to do with divergence. Okay, we just showed you the easiest way to trade the MFI. It's time to up our game a little bit. Let's talk about divergence and how you can trade reversals with the MFI. Okay, let's up the ante a little bit with our MFI trading strategies and talk divergence. The first type of divergence is bullish divergence. This is a signal to buy the market. Essentially, we have a series of lower lows in price action and a series of higher lows in our MFI indicator. That's going to be a signal to buy. Now, in this instance, it really did signal a reversal. Those selling pressures coming out of the market, and we get in on the buying pressure. It really a fantastic entry point. Take profit's going to be somewhere above our buy. Our stop loss is going to be typically beneath the trend line that we have for our lower lows there, and that's a situation where you're going to always want to line up your take profit with your stop loss to be on a fixed risk versus reward, potentially greater than 1-to-1. Reversal 1-to-2, 1-to-3, 1-to-4. That's up to you, your call. This right here gave us a great shot, made a few hundred pips and a real nice trade. Now the second type is going to be bearish divergence. This is going to be a signal to sell the market. Now under bearish divergence, this occurs when your MFI forms a series of lower highs, while price action forms a series of higher highs. Now this signals to us that the buying pressure is weakening and a reversal to the downside could be on the way. Now always remember that with divergence, we don't necessarily have to catch a reversal. Sometimes we can catch a very, very small pullback in price and still be able to profit. What matters is whether our stop loss and take profits are aligned. So in this instance, we're going to be looking to put a sell on, and that's going to put our stop loss right above this swing high, right above our entry point, and our take profit's going to be beneath underneath price, stop loss above price, typically above that swing high. Once again, you're going to want to have a positive expectancy, at least a 1-to-1 risk versus reward. And you'll see, right, in this instance, you didn't get in on a big time reversal, but you either got a profit on a pullback or you stopped yourself out before a big time market move really ran against you. So that's the name of the game with trading, positive expectancy trades, good risk versus reward. So two types of divergence: bullish divergence, you're looking to buy the market, and here bearish divergence, you're looking to sell the market. Each way is a more sophisticated method of trading your MFI. It takes a lot of practice to spot divergence in real time. Don't shy away from it. Don't be buffaloed by the concept. Get in the markets, look at price action, get good at spotting divergence, and you can catch reversals and pullbacks as well as anybody using your MFI and price action indicators. The Money Flow Index is a powerful tool for spotting overbought and oversold markets. It does this by evaluating price and volume data. Basically, when money's moving out of an asset, the market becomes oversold, and that's a signal to buy the market. On the other hand, when money is flowing into an asset, the MFI tells us the market is becoming overbought. That's an opportunity to sell the market. Of course, it's important to always use caution when trading any technical indicator. No indicator is 100% accurate, not even the MFI. It's imperative to make sure that you consistently adhere to a process designed to maximize your capital. In the case of the MFI, trending markets can produce many false signals. That's one reason why many traders combine the MFI with other indicators to confirm the buy or sell signals before ever committing money to the real market. Thanks for stopping in and checking out our video on the Money Flow Index. If you want to learn more, subscribe to the channel or check out one of our live streams. Until next time, trade the action well, and we'll see you in the markets.